There is one investing mistake that is more widespread, more financially damaging, and more silently destructive than any stock pick error, any market timing failure, or any fee you've ever paid. It's not sexy. There's no dramatic story to attach to it. And because it doesn't feel like a mistake in the moment, it often feels like smart, prudent behavior. Most people making this mistake have no idea they're doing it. The mistake is investing too conservatively for your age and time horizon. Let me explain exactly what this means, why it's happening, and why its consequences compound invisibly over decades. In 2024, approximately $2.5 trillion sits in low-yield savings accounts and money market funds held by Americans under the age of 50. Some of that money is emergency funds, which belong in savings. The rest is money that people intend to invest long-term but have left sitting in cash because the market feels risky right now, because they're waiting for a better entry point, or because they simply haven't gotten around to investing it. This is not a small mistake. This is the single most statistically significant error in retail investor portfolios, measured by its impact on terminal wealth. Let's run the numbers. A 35-year-old has $50,000 in a high-yield savings account at 4.5%. They tell themselves they'll invest it once the market settles down. They'll know when the right time is. The market is at all-time highs, after all. Doesn't it make sense to wait? Scenario A. They invest the $50,000 in a broad S&P 500 index fund at age 35 and hold it to age 65. At 10% annualized return, $50,000 becomes approximately $872,000. Since the 3-year wait, which felt like smart, prudent risk management, cost them approximately $220,000. Not in bad investments, in time, in foregone compounding. The psychological mechanism behind this mistake has a name: time discounting with vividness asymmetry. The potential loss from buying at a high and then watching the portfolio drop is vivid and concrete in the mind. You can imagine opening your account, seeing it down 20%, and feeling sick. That image is immediate, emotional, and real. The opportunity cost of waiting, the $220,000 in foregone compounding, is abstract, and here's another number worth sitting with. Research from JP Morgan's Guide to the Markets found that if you had invested in the S&P 500 from 2003 to 2023 and missed only the 10 best single trading days of that 20-year period, your annualized return dropped from 9.8% to 5.6%. Miss the best 20 days and your return collapsed to 2%. The problem: the best days in the market almost always cluster within 2 weeks of the worst days. The investor who panics and moves to cash during a market crash will miss the sharp recovery bounces that happen immediately after. The investor who waits it out gets both. You cannot time the bad days out and keep the good days in. The data is unambiguous on this. You either stay in the market, or you sacrifice a portion of the return that no amount of smart timing can recover. Dollar cost averaging, investing a fixed amount at regular intervals regardless of price, removes the timing decision entirely. You invest $500 on the first of every month whether the market is up or down. Some months you buy at a high, some months you buy at a discount. Over years, your average cost smooths out, and your total return reflects the market's long-run performance rather than your timing ability. Vanguard's research on this specific question found that lump sum investing outperformed 12-month dollar cost averaging in 68% of cases across 12 global markets. The reason is simple: markets trend upward on average, so money invested earlier has more time to compound than money spread out over 12 installments. But dollar cost averaging wins in the 32% of cases where markets decline in the period immediately after the initial investment. More importantly, DCA produces better outcomes for investors who would otherwise stay in cash entirely due to fear. The perfect lump sum entry is irrelevant if fear prevents you from executing it. A strategy you can actually implement beats a theoretically optimal strategy you can't bring yourself to use. Many workers have a 401k defaulted into money market or stable value fund, yet research on 401k allocations shows that a significant percentage of workers in their 30s and 40s are holding 30 to 50% bonds, the allocation appropriate for someone 5 years from retirement, not 25 years out. These workers are dramatically reducing their long-term accumulation in exchange for short-term volatility reduction that they don't actually need. Target date funds solve this problem automatically. Vanguard Target Retirement 2055, Fidelity Freedom 2055, Schwab Target Date 2055. Each holds approximately 90% equities for investors in their 30s and automatically rebalances toward bonds as retirement approaches. Research consistently finds that target date fund users maintain more appropriate equity allocations at every age, experience fewer panic sales during downturns, and accumulate higher balances than self-directed investors who manage their own allocation, often because self-directed investors skew conservative out of fear. Here's the age-based allocation guide that most people never see spelled out plainly. Under 30, 90 to 100% equities. You have 35 plus years. A 50% bear market is a buying opportunity, not a catastrophe. Ages 30 to 45, 80 to 90% equities. Time is still on your side. The compounding of high equity exposure during your peak earning years is the engine of retirement wealth. Ages 45 to 55, 70 to 80% equities. Begin adding bonds. Ages 55 to 65, 60 to 70% equities, increasing bond allocation as retirement approaches. At retirement, 50 to 60% equities. You still need 20 to 30 more years of portfolio growth to fund a full retirement. Going too conservative at 65, say 30% equities, puts you at risk of running out of money by 85 because the portfolio grows too slowly to outpace withdrawals and inflation. The people who go most conservative at retirement are statistically the most likely to outlive their money. Longevity is the risk nobody prices correctly. If you are under 40 and not 100% in equities, or very close to it, ask yourself why. If the answer is, I don't like seeing my account drop, that's a behavioral preference, not a financial strategy. A 30-year-old's account dropping 30% is a non-event if they don't need the money for 30 years. A 30-year-old's account growing 30% slower because of excess bond allocation, compounded over 30 years, is a multi-$100,000 difference in terminal wealth. The third form is holding cash that should be deployed. Interest rates on savings accounts in 2024 are the highest they've been in 15 years, 4.5 to 5%. This has led many investors to treat savings accounts as an investment vehicle. They're not. A savings account earning 4.5% over 30 years turns $50,000 into approximately $175,000. The same $50,000 in the S&P 500 at 10% turns into approximately $872,000. High-yield savings is appropriate for emergency funds, money you'll need within 12 months, and the cash portion of an all-weather portfolio. It is not appropriate for money with a time horizon of 5 years or longer. The opportunity cost of keeping long-term money in savings rather than equities, particularly during periods of high savings rates that create the illusion of a good return, is enormous, and the illusion is the most dangerous part. When a savings account earns 5% and the news is full of market volatility, it genuinely feels like the smart choice. That feeling is exactly what makes the mistake so persistent across so many intelligent, financially aware people. The savings account wins the emotional argument every time. The market wins the mathematical argument every time. Over 30 years, the mathematical argument compounds by a factor of 5. The fix is simpler than the problem. Step 1. Inventory every dollar you have beyond your emergency fund. Identify the time horizon for each. Money you'll need in less than 1 year, keep in savings. Money with a 3 to 5 year horizon, consider intermediate term bonds or conservative balanced funds. Money with a 5+ year horizon, equities. Step 2. Automate the investment of every dollar above your emergency fund with a long-term horizon. Make the investment the default. Make choosing not to invest the active decision. Step 3. Check your retirement account allocation against your actual time horizon. If you're under 45 and less than 80% in equities, consider whether your allocation reflects your actual risk and return needs or just your emotional comfort. The fix for investing too conservatively requires only 2 actions. Calculate the time horizon for every dollar you have beyond your emergency fund and match each dollar's allocation to its time horizon. Money needed in under a year belongs in a high-yield savings account. Money with a 5+ year horizon belongs in broad equity index funds. If you're 40 years old with $200,000 in a savings account because you're waiting for the right time to invest, the uncomfortable truth is that the right time was 10 years ago. The second best time is now. Every month of delay is a month you can't recover. The market doesn't offer refunds on foregone compounding. The people building real wealth aren't doing something complicated. They're doing the boring, automatic, time-in-the-market thing for years, without interruption. The biggest mistake isn't picking the wrong stock. It's letting money sit in safety when it should be working. What's sitting in your savings account right now that should be invested? Be honest with yourself. The math doesn't care about your feelings, it cares about time. And every month that money isn't in the market is a month you can't get back. Subscribe because next week we're covering 7 specific stocks I would personally buy right now with $10,000, dividend plus growth, and the thesis behind each one.